Well, good afternoon and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HYROX, will not be with us today. He's in the hills or mountains of North Carolina getting some spring cycling training, so I'm sure he'll be back with us next week, but our financial planner and wealth forecast specialist, Bianca Tomlinson, is with us today as well. Now, we are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website on the home page. And while you're at it, you may be interested in our voluntary code of conduct as well, something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. Well, as we usually do, let's start with a quick review of our themes for 2017. We think that our strategy of having a tactical perspective to investing is even more important in 2017 because of the even greater levels of uncertainty imposed on us by a host of developing factors. You know, inflationary expectations had been rising, but recent data suggests that inflation is actually stalling at the moment. While other central banks have been more cautious, the U.S. Federal Reserve raised rates by 0.25% on March 15th, and they are expected to do so at least 2 more times over the course of this year. Stock market valuations are at 14-plus year highs, putting stock prices well above the prices of the 10-year average valuation. And at the same time, in the U.S., economic growth has not kept pace with stock market advances. And the Trump agenda appears to be running into some political hurdles. Brexit has been initiated, and the French elections have rejected populism. Meanwhile, protectionism concerns continue to rise, especially in Canada with all of what has been going on, and I'll get to that in a bit. Throw in some escalating tensions with North Korea and all the things going on with Russia, and we have still got quite a blend of uncertainty. Well, one of the reasons that we desire a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between stocks and bonds, both in the U.S. and in Canada as well. And we do talk about from week to week, those correlations continue to move in opposite directions with the stock markets rising considerably over the last few days, but bond markets, while their prices are falling a little bit, really haven't moved significantly, and we'll talk a bit more about why that might be as we progress through the program today. When we began our advanced approach to portfolio management back in 2015, we added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. And we are patient, waiting for opportunities to buy assets, as we expect that we will get those in the not-too-distant future. Well, the benchmark equity index that we use for comparison has returned close to 13.75 from this time last year, and only 3.5% annualized since this date 2 years ago. And this emphasizes the kind of volatility we've been experiencing over this time period. Meanwhile, the benchmark bond index has barely had any positive return over the last couple of years, leaving investors with a greater weighting of bonds with little to show for it. And each week, I look at how short-term and long-term returns have progressed in our benchmark ETFs for comparison to client portfolio performance so we can continue to monitor our clients' progress. And each client will likely have a different starting point and may have different allocation weightings. So for newer clients, there may be some differences in their personal portfolio returns, especially in the short run. So we want to focus more on the long-term returns because they're, in the end, is how we will be judged, because we want to be able to achieve each of our clients' long-term goals. Now it is a little past the end of the first quarter of 2017, so all of our clients should have their reports, their quarterly reports, and I have had a couple of calls from clients asking a few questions here and there, and I want everybody to know that we are always open to get calls or even emails to have discussions if you have any questions or concerns whatsoever. So please make sure that you get in touch if we can be of any assistance whatsoever. Well, as we look at longer-term HIROC, a longer-term HIROC client, the one-year performance after fees is now well ahead of the benchmark by almost 2 percentage points. So our one-year return for a longer-term clients has been doing quite well. Our 4.5-year return on this particular client is about a little over 3% ahead of our benchmark. So it is really the tactical approach that provides the better risk-adjusted returns. You don't have to be as focused on the higher risk equity markets to get those returns either. So for long-term performance, you can see that it does speak for itself. And as we talk about each week, we continue to focus on the difference between what we call absolute returns and the risk-adjusted returns. And what is most important is that the actual HIROC private client return per unit of risk taken, which on an apples-to-apples basis significantly outperforms the 60/40 comparative benchmark. So graphically, you can see that the absolute return for the HIROC private client is higher and the risk taken significantly lower. And as I think all of you know by now, historical returns are no guarantee of future returns. But at HIROC, as you also know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy, and our forecasts for your net worth into the future are up to date and heading in the right direction. Well, we are watching the global inflation story closely. And as all central banks have a mandate to maintain price stability, we're focusing on inflation as a key to determine if and when interest rate policy may change. Now, while total inflation data had been rising on a global scale, most recent data has actually shown it to be slowing. The Bank of Japan, the Bank of England, the European Central Bank have kept their rates steady and monetary policy unchanged, as has the Bank of Canada. With the uncertainty surrounding the French election now in the past, it is more likely that the European Central Bank will look at possibly making some adjustments to its monetary policy. Well, they meet on Thursday, and we will be looking closely to see what might be in their plans for the future. Also, the Bank of Japan has begun to test the removal or how to remove the stimulus that they've been adding, but they will also be meeting this week and actually announce their plans tomorrow. Well, in its most recent monetary policy report, the Bank of Canada highlighted its concerns over U.S. policy, especially any protectionist policies, and we talked about this last week, but protectionist policies that may come out as NAFTA is renegotiated or for other reasons. They believe that this protectionism will elevate economic risk for Canada and create high levels of uncertainty that force businesses to postpone investment decisions, and these risks will likely keep the Bank of Canada's monetary policy steady for the time being. And of course, if you haven't been aware, Donald Trump signed an order to slap a duty on Canadian lumber this week. and President Trump is now making threats about dairy as the northern neighbor of Canada has suddenly unexpectedly become his #1 target for criticism lately on trade. Needless to say, this is not going to encourage the Bank of Canada to change their monetary policy soon, because it is, of course, falling into their concerns over protectionism. On the inflation front, the Consumer Price Index in Canada rose 1.6% on a year-on-year basis in March, after a 2% year-over-year gain in February. So inflation is also coming back, total inflation. But as we look at the Bank of Canada's core inflation indicators, they are all below their 2% targets. So you can add that to the list of issues that will hold monetary policy unchanged and likely keep interest rates, the policy interest rate, at 0.5% for some time into the future. As I said, Canadian interest rates, which are here in red on this chart, are not expected to increase, but U.S. interest rates in blue are expected to increase significantly more quickly. All of this, especially the lumber tariff, has pushed the Canadian dollar to its weakest level in against the U.S. dollar since early 2016. Now in the U.S., recent economic data has forced economists to lower their expectations for the first quarter U.S. economic growth. We will see GDP results announced this Friday, or the preliminary results anyways, but obviously the U.S. economy hasn't been showing much resilience lately. Households, businesses, and investors started the year riding a wave of rising expectations for growth with a new business-friendly president in the White House, but the euphoria hasn't translated quickly into broad economic gains. Bank loan growth has slowed, economists have marked down projections for output growth, and consumer spending has taken an anemic turn. Well, 2 weeks ago, we noted that the softer survey data, like consumer confidence, was rising, but confidence tends to peak just before a recession, as it has done in the past. Today, consumer confidence for April was released and dropped to a level of 120 from March's level of 125. So we have to wonder, was the peak actually in March? So we'll be keeping a very close eye on what's happening with consumer confidence as we move forward. And despite rather buoyant stock markets following the relief from the French election, bond markets are telling us that the hard data is still more compelling. And although the yield curve has steepened a little bit from last week, it has been flattening over the last couple of months, led by lower long-term bond yields. And we know that bond markets do tend to lead other financial markets. And we know that a flattening yield curve, where the 2-year bonds that are in gold rise to intersect with 10 and 30-year bond yields that are in green and purple, that has historically indicated that a recession will follow soon thereafter when they connect. If the Fed raises interest rates, and they are expected to do so at least 2 more times this year, as I mentioned, the yield curve could flatten further. So at the same time, a slowing U.S. economy is moving 10 and 30-year bond yields lower. We do want to pay attention to what bond markets are telling us, because they do lead all financial markets. On the debt watch, we've been talking and pointing out the risks of record amounts of global debt with rising interest rates. This puts increased pressure on debt servicing. Canadian household debt is at record levels, and U.S. household debt has jumped to higher levels than it experienced in 2008. And emerging market companies are bringing on U.S. dollar debt that could become a source of trouble in some parts of the world if growth slows and interest rates rise, or the U.S. dollar resumes its ascent. Governments and companies in the developing world sold $179 billion in dollar-denominated debt in the first quarter, the most dollar debt ever raised in the first quarter, and more than double the amount raised during the same period last year, according to data provider Dealogic. In all, U.S. dollar debt stood at $3.6 trillion in emerging markets through the third quarter of 2016, an all-time high according to the Bank for International Settlements, including local currency debt, and emerging market companies have increased their borrowing by staggering 17 trillion since 2008, according to the Institute of International Finance. In China, authorities have tightened financial regulation and credit control and are using an expanded monetary policy toolkit to deleverage without trying to curb economic recovery. Policymakers are wary of debt piling up in corporations, local governments, and even households. They are eyeing investment booms in financial markets ranging from stocks, bonds, to farm produce futures with extreme caution. This year, the task in hand is to reduce leverage and contain financial risks. Things have escalated in recent weeks. The banking regulator has issued a flurry of directives on risk control and threatened to come down hard on malpractice. The China Banking Regulatory Commission last week ordered lenders to conduct self-inspections, focus on non-performing loans, fix regulation loopholes, and engage in more debt for equity swaps. And this has caused bond and stock markets in China to sell off. Well, each week we look at value, and there's been really little change with lower earnings expectations and higher prices. The price-to-earnings ratio has jumped close to its highest level in 14 years, while the 10-year average is considerably lower, about 20% lower, which means basically that in order to come back to the average, and we know that in all circumstances, things eventually return to the mean. The S&P 500 will need to correct lower by about 20%, or the earnings will have to grow by 20% more than they're currently expected, and they're already expected to grow fairly significantly. So the combination of both likely means that we're going to see some kind of correction in equity markets, and it's risk that we just don't want to have at this point in time in our portfolios, even though markets are making new highs. When markets make new highs, though, obviously that just entails a greater risk and makes us more cautious. Another metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. And as I mentioned, stock prices are way ahead of U.S. economic growth, which means that at some point something will likely have to give. And interestingly, we mentioned this last week, but I thought I'd bring it up again this week. There's really only 10 stocks that have been responsible for over 50% of the growth in the S&P 500 this year, mostly technology and internet stocks. And 3 of those stocks, Apple, Facebook, and Amazon by themselves, have been responsible for about 1/3 of the increase. And that's a real lack of depth in the stock market. And that also concerns us quite significantly, which we think could spell the peak in the cycle, because a lot of buying right now is emotional buying, and again, something that we know historically is something to avoid. Well, lots going on the geopolitical front this week. Let's start in the U.S. We're keeping an eye on policy developments there. President Donald Trump has ordered White House aides to draft a tax plan that slashes the corporate tax rate to 15% from close to above 35%, even if it means a loss of revenue, which would mean a significant increase in the budget deficit. But during a meeting in the Oval Office last week, Mr. Trump told staff he wants a massive tax cut to sell to the American public. He also told aides it was less important to him that such a plan could add to the federal budget deficit, though that might make it difficult to sell to the Republican Party lawmakers, who are very much and very wary of such a large tax cut. Mr. Trump told his team to get it done in time to release a plan by tomorrow. And Mr. Trump's willingness to let deficits run higher also could hinder the passage of tax cuts that are permanent. Also, President Trump is open to waiting until later this year to secure funding for a wall along the border with Mexico. White House officials said Monday night that in a shift that could clear the way for lawmakers to strike a deal to avoid a government shutdown on Saturday. Mr. Trump and top administration officials had previously indicated the president wanted to include money to begin building a wall along the southern border in that particular bill. So as we watch for healthcare reform, the budget resolution, tax reform, and infrastructure spending. All of this, or a lot of it, hinges on some things getting done this week. So we're keeping a close eye on what happens there. And in Britain, Prime Minister Theresa May was against Brexit before the EU referendum, but now says that there can be no turning back and that Brexit means Brexit. The reason she gave for calling a general election was to strengthen her hand in negotiations with the European Union, in which she plans to withdraw the UK from the single market and strike a new free trade deal. Well, global stock markets rallied as centrist candidate Emmanuel Macron won the first round of France's presidential election, diffusing some of the political tension that had been weighing on share prices. He will face off on May 7th in the election's second round against National Front leader Marine Le Pen, who has campaigned to take France out of the euro and certainly has rattled global markets by suggesting that she might do that. Now, opinion polls on Sunday suggested Mr. Macron would win a head-to-head contest. So that's why stock markets on a global scale have been rallying, because that uncertainty seems to be being taken out. But as I've mentioned, there are lots of other uncertainties still pending. And as I also mentioned, North Korea is a bit of a problem at the moment. Their military conducted huge live fire drills today and issued new warnings that it would defend itself against the American imperialists amid high tensions and a military buildup in the region. But the United States and its South Korean and Japanese allies showed their muscle as well by conducting military exercises of their own. In addition, one of the largest U.S.-guided missile submarines showed up in the South Korean port of Busan, presaging the imminent arrival in the region of a naval strike group led by an aircraft carrier. The military buildup on both sides comes amid heightened tensions over North Korea's nuclear and missile programs and warnings from the Trump administration that all options are on the table for dealing with the regime in Pyongyang. So here we are at High Rock with all of this upheaval happening around us. We continue to monitor all this event risk, which we think is high, and that price valuation is also high, too high for us. And we will add or reduce holdings in our models as opportunity presents itself, but we'll also maintain our disciplined approach to our strategies with skill and competence and our deep levels of research, which makes our tactical approach add value and reduce risk to give all of us the best possible risk-adjusted returns. Well, as always, we want to take, first of all, thank you for taking the time out of your busy schedule to tune in. I don't know if there's any questions or not today from any of our listeners. I don't think we're getting any. So, but if you have any questions or concerns, obviously we want you to feel free to email them to us. We'll be back certainly with our next update next Tuesday. But until then, this is Scott Tomlinson on behalf of my absent colleague Paul and our present colleague Bianca. We want to wish you all a wonderful rest of the week. We'll be back with you next Tuesday.